Good morning, everyone. Is Carmen in the room by any chance? From the Chicago teachers? I know we're a little bit ahead of schedule, but oh, Ash, if you could sit here. Yeah, assigned seating. Excuse me. Well,
nowhere to go.
Yeah. Well, thank you very much for joining us this morning. We do expect Carmen to show up momentarily, and when she does, she will certainly be part of the program. Let me take a few minutes to set the table about why we're doing this and what our objective is in terms of this conversation with CIOs. But before we do, I'd like to, again, reintroduce this notion of asking questions of the panelists through our NCPERS conference app. So if you've had a chance to download the app on your smartphone, you'll be able to go to the attendee list, and on the attendee list, if you click on my name, a screen should show up that says that at the bottom of it, a button that says email Hank Kim, and if you click on that, you will be able to send me an email and ask the question of the panel. Otherwise, if that's too modern for you, we can still do it the old-fashioned way, which is stand up and yell out your question. So either way. So the reason we want to have this conversation is we wanted to get a sense of where public plan CIOs are as we're coming out of the Great Recession. And what we tried to do is have a diversity in terms of size, the plan sponsor, as well as geography. So to my immediate right is Ash Williams, who is the Executive Director and CIO of the Florida State Board of Administration. Carmen Lopez, who is the CIO of the Chicago Teachers Plan, will be joining us, and she will be to my immediate left. And then to my far left is Girard Miller, who is the CIO of the Orange County Employee Retirement Systems. So why don't I do this? Let me give each of the panelists a couple of minutes to introduce themselves more fully to the audience. And why don't we go from here? Girard, why don't you take a few minutes and talk a little bit about yourself and your plan?
Well, Orange County is the place that went bankrupt many years ago in Southern California. The county has about 3 million people. The plan itself has an $11 billion portfolio with liabilities somewhere north of $15 billion. Funding ratio, when you run the math out, is less than 70% presently. I joined 2 years ago. I've got a career that goes back almost 40 years now, doing a whole bunch of different things in different lives, and came in to provide public service and to try to help this plan work its way back out of the hole. And one of the long-term goals, of course, is to achieve full funding. I'll save other comments until later. That's kind of the short course.
Thank you, Gerard. Ash?
The Florida State Board of Administration is a financial services provider for the state of Florida. We're perhaps best known for managing the assets of the Florida retirement system. The FRS has a little over 1 million beneficiaries, active and retired. We run both defined benefit and defined contribution plans. Our aggregate assets are about $180 billion. Of that, 80% or so is retirement system assets. The remainder are in either other entities we manage money for in state government, or a cash pool that we manage for the benefit of local governments throughout Florida. We also do something that's a little unusual for a pension organization. We're in the reinsurance business. We run the Florida Hurricane Catastrophe Fund, which currently has about $11 billion in assets, and provides the reinsurance to all the primary insurers on residential property interests in Florida. This is my second tour at the State Board. I came back in the fourth quarter of 2008 to help the fund regain its footing and do a little brand rebuilding. Previously, I'd spent 12 years in New York, the last 9 at a hedge fund, and the 3 before that at a private asset management firm. And in the period 91 to 96, I was in exactly the same job in the same building that we built in 1992, in the same office I sit in today, at the same desk. It was sort of a Groundhog Day experience to go back.
And probably the same salary, right, Ash?
No, it went down. Just kidding. Just kidding.
Carmen, welcome. If you take a few minutes and just introduce yourself and your plan to the audience.
Sure. Thank you very much for having me here. My name is Carmen Heredia-Lopez, and I am the CIO of the Chicago Teachers Pension Fund. The Chicago Teachers Pension Fund was established in 1895 by the state legislature. We have approximately 60,000 members, half of them active and half of them retired. And we offer retirement, survivor, disability, and health insurance benefits. The fund is approximately $10.2 billion, and our funding ratio is approximately 50%. Personally, I have been in the business for over 20 years. I started in the asset management side, and therefore the pension funds were my clients. So I know what it's like to be on the asset manager side in terms of trying to get assets. And specifically, I know what it's like to work for a small investment management firm and how hard it is. So being on this side has proven to be very educational for me. I see the big picture now, and with the experience that I had on the investment management side, then I try to help the managers since I know what it's like.
Great, thank you. So let's get right into it. One of the first questions we have is, in terms of asset allocation, how are public plans looking at what's to come over the the near term, over the next 5 years or so? Carmen, since this is your city, why don't we start with you? How is the Chicago Teachers Plan looking at asset allocation? Excuse me.
Sure. We are primarily in equities. I think like most plans are. We're approximately 61% in equities, and that would include domestic equity, which is 29%, international equity 29%, and then 3% in a private equity portfolio. We have approximately 23% in fixed income and cash, and then the rest is what we've recently termed as a real assets bucket, which is 14%, and we recently increased that from 11 to 14%. And that is made up of private real estate, 7% private real estate, 2% in REITs, 3% in infrastructure. And the new asset class that we've added is commodities. And the reason we've added that is not necessarily because of the expected returns. According to our consultant, the expected returns for commodities are probably 2.75%. But the reason we've added that to the plan is we're looking at risk. So I know we'll delve into that a little bit later on, but we certainly put a heavy emphasis on looking at the risk when we're constructing the portfolio. We also have a bucket which you can term as opportunistic, but it's, again, looking for diversifying assets because we want to diversify the risk when we do the portfolio construction.
Great, thank you. How about you, Ash? What's your focus, and particularly as a State Board of Administration that have investment authority or function for so many different agencies? Is your allocation different for that reason?
No. The way the Florida retirement system works is our beneficiaries are not just state employees. In fact, the state is only about 20% of our beneficiaries. Fully 80% of our membership are county employees, and of our membership, roughly half, 49%, are in fact teachers who work for local school boards all over Florida. So the benefit that beneficiary base brings us is the ability to have a very long-term oriented, very diversified asset allocation, which, similar to what Carmen just outlined, is I think what most of us have. I think you have to back up to first principles and answer the question, what drives your asset allocation? And the first thing is really basic, and that is you want to maximize the probability that you have the assets on hand to meet the benefit obligations when they come due over the long term. The mirror image of that objective is that you want to minimize the probability that you run out of money before the benefits, when you have to pay the benefits. So what we've really focused on in the work we've done in allocation over the past couple of years is to take risk more intelligently. The whole mission of a pension fiduciary is to balance risk and return in a way that you maximize that objective of having the money to meet the needs when they're presented. And what we've done is take into consideration the historically low fixed income returns that we're currently seeing and that we'll be in for a long time, and face the reality that fixed income is not going to contribute much to overall returns in the intermediate future. So what we've done is take down our fixed income exposure a bit from a target of 24 to a target of 18%, and we've spread that 6% change 3% to real estate, 1% each to global equity, private equity, and strategic investments. So if you look at how our layout currently works, our targets are 53 global equity, 18 fixed income, 10 real estate, 6 private equity, 12 strategic, and 1% cash. In fact, we're not at those allocations. We have more like 59%, 59-60 in global equities because that market's been hot, and we've been rebalancing away from global equities and using that rebalancing using the proceeds of those monthly rebalances or periodic rebalances to pay our monthly benefit flows. We pay out about $600 million in cash in benefit payments.
And Girard, what's your perspective? And since Carmen sort of touched on it, why don't you kick off the discussion, not only in terms of your perspective in terms of asset allocation, but about risk. You know, most observers feel that we are almost at the zenith in terms of the economic growth. And so how is your plan allocating your assets to protect any downside risk if there is a recession over the next handful of years?
Sure. Well, by background, I'm not going to get into 3% of this and 6% of that and the rest, but I'd say that the Orange County plan reflects two things. One is the underlying conservatism of the population base, and so I would say that our appointed members, which are sort of half the board with the other half elected by employees and retirees, tend to be conservative business people, so that has an impact on how they think about risk. And then this is a county that went through bankruptcy, so you can imagine that the elected county treasurers who've served on that board over the years have been quite risk averse. And as a result, the portfolio construction for the last 10 years has had a conservative bias. Less emphasis on equity, more in diversification across asset classes. And historically, when you look at the numbers, we are typically in the northwest quadrant in terms of risk return, but it's because we're a very low risk plan. We end up getting lower rates of return in up years than do most of the California pension plans that are in our peer group, and we tend to lose considerably less in the downside. And so that's sort of baked into the system in terms of a mentality. Our trustees think about things in terms of risk-adjusted return, not just the sweepstakes. So they're quite content the fact that we may have lagged performance by other plans by 3 or 4% in the last year in a strong 30% upward equity market. Nobody on my board's losing any sleep about that, including the labor people, which is kind of interesting. We have addressed the risk issue in a couple of ways. One is a 2012 asset allocation plan that divided the pie up into many more slices. That hurt us last year in particular. The word in the industry is the more slices you have on your asset allocation pie in 2013, the worse you did. No question about that. So we've got, commitments toward global tactical asset allocation, real return, there's a commodity sleeve, there's a hedge fund sleeve, all of those things are there. With interest and concern about downside protection. What we did do last year that's unique, we put out the nation's first comprehensive risk advisory services RFP, not just to get the risk analytics to build in, but also to get an independent risk advisor for the board, but to bundle that together in a comprehensive package. Ended up hiring BlackRock Solutions to do that. And we're about to win a national award with another professional association for the groundbreaking work we've done. One of the things that's part of that is an economic dashboards element. You talked about where we are in the cycle. My staunch position is we're in the bottom of the 6th inning, not the bottom of the 8th inning, and we've got pretty good economic cycle work that we're doing, which is available to all of you, by the way. I'm happy to take business cards. We are distributing this information freely by internet to people who want to get our economic work done, which has been lauded by some of the largest pension funds in America as being some of the best and has now been nationally recognized. So where this is all going, this week, on Wednesday, I go through a dynamic risk mitigation discussion with my Board of Trustees that lays out what's our strategy going to be for the next 2 or 3 years and how will we deal with that. I won't go into the details now, but we're on that pattern and we have some pretty clear thinking about it. I'll be happy to share my material with anybody who's interested.
Carmen, Ash, any thoughts about the downside protection?
Well, like I mentioned, in September of 2013, our trustees passed a new asset allocation, and the main purpose of that, or the major change, was our focus on risk. And we were trying to keep the same expected return, but our risk level went down.
I would just say broadly, diversification is our friend, and Girard said something that's exactly right, which is in certain periods of time, if you're not in whatever the hot asset class happens to be, you will lag. That's not a bad thing. It's perfectly all right because we're not short-term players. We're long-term players, and you've got to remember that because so many of the constituencies we all deal with are focused on what happened last week, what happened a month ago, what's a trailing 12 months, particularly the media. There's zero memory of anything that's institutionally significant. And in that regard, diversification is your friend. We do a little chart we call the quilt, where we have different colored boxes for our different asset classes, and we rank them with verticals being the performance from highest performing to lowest performing, and the horizontal being years. So this little box is a matrix of, I guess, 24 squares, however many asset classes we have, 5, 6, whatever it is, times 6 years. 36, I suppose. And what's funny about it is what's best in any given year is almost never the same. Twice in 6 years, real estate was the best performing asset class. So the point is, if you're in a lot of different things, you can afford to go through tough conditions for a period of time that hurt you in some areas, but other areas will do well. The negative to that, of course, is that there are times like 2008 when correlations go to 1 and everything seems to blow up at once. But those are rare, and you tend to come back from those. I think the other thing Girard said that I would follow up on a little bit is the importance of holistic understanding of risk. The work that Orange County has done there is important, and it's valid for everyone, because when you go down this road of diversification that I just sketched out, the risk is you end up holding some of the same underlying assets in a lot of different places, and you have risk concentrations that you don't realize you had. And if you do the kind of work that was just outlined, you figure that out and you avoid that manhole before you step into it.
So we have our first question from the audience, and it is specifically, what are your thoughts on investing with low-cost index funds? So I guess more generally speaking, active versus passive investing. Who wants to go first?
I'll take a start. I have a dear friend in the audience I work with from Fidelity who hates me for this and the rest. We have gone 100% index with large cap domestic. When I came in, things were headed in that direction, but our view is we have great humility about our ability to actively select money managers, and in areas where markets are highly efficient, we're deeply skeptical that we're going to add return. We'd rather try to find opportunities for alpha generation in a lot of other areas, and I'll be talking about what we're doing in alternatives and the rest. So that's been our focus. We're having an intense internal battle right now about whether to go the index route versus retaining what we have in the domestic small cap space. There are areas, parts of the market, we firmly believe that those areas that get less research concentration, emerging markets being a good example, are still excellent areas for excess returns from active management, but that's been our point of view. My staff loves active managers is a general thesis. They all kind of grew up in that world, and I said, show me the proof of your ability over the last 10 years to put together a stable of active managers. I think the cards are stacked against public funds being able to proactively select money managers, typically using 5-year performance patterns, buying the managers at the top, dumping them at the bottom, what is known as the Steinbrenner syndrome. Okay, and that is the fatal flaw in our industry that gives me great humility to believe that I can actually produce better returns in widely researched, well-researched markets. So that's sort of our point of view. That's, again, 10% of the total. It's not that we're out there with 40% of the total fund on that end. And in fixed income, I'm the exact opposite. We think we're in a 10-year period of secular rising interest rates. Holding the Barclays aggregate, to me, would be the stupidest thing we could do. And I would rather have unconstrained bond managers and pay them for the ability to move through and maneuver that area. So we're not doctrinaire. It really requires selectivity and thoughtfulness on your own part about what you're trying to do with your money.
Well, having graduated from the efficient market school here in town, you would think that I would be more pro-passive management. However, our fund has 28% in passive management. What I have seen, however, and to your comments, Girard, is that there are some managers that do outperform. So I guess that's the mix of the art and the science of asset management. We do have some money managers in large cap that are outperforming historically since inception. So there are managers that are good managers. Some of them I think the audience might find in the emerging managers, because these are small managers that are very focused and can move fast. Additionally, I agree with you in terms of equity. There are opportunities where the markets are inefficient, and we're looking at the international small cap space as well as the domestic small cap, where there are managers that consistently outperform. In terms of fixed income, we do not have a Barclays Ag index. Our index is the government credit, which has performed wonderfully for us, since inception. And we are looking also at alternatives. However, the step back that we take when we look at our alternatives are the fees, and I'm sure we'll touch upon that.
Yes, I think we will. Ash.
A couple of thoughts there. First of all, I think passive investing makes terrific sense. If you can reduce costs, it's the same thing as having more return. And if you're in a return environment where the absolute returns are comparatively low and you can avoid 100 basis points of cost, it's really powerful. I would tend to correlate the appropriateness of passive management with the liquidity and transparency and efficiency of the market in which you're considering deploying it. So, for example, using U.S. large cap equities as an example, that's the most liquid, efficient market on the face of the earth. The likelihood of having sustained active management outperformance there in aggregate, in scale, over a long period of time is extraordinarily small and probably not worth the cost. So for that reason, we do most of our core U.S. equity exposure passively. And yes, you can do it very cheaply through an index fund. You can do it even more cheaply on your own desk, which is what we do. But we have the size to do that. And we can have full-time traders and analysts and whatnot to maintain that exposure. We can do it at about 0.2 of a basis point in cost. That's a huge advantage. If you go outside, you can do it for a little more than a basis point, somewhere between 1 and 6, I would say, depending on your size. What we'll tend to do is go more and more active the further into the fringes of efficiency and transparency one gets. So if you think about U.S. markets, we would look at active management in small cap or micro cap. We like active management as you get into ex-U.S. developed markets, think Western Europe, UK, and even more when you get into emerging markets, and when you get into frontier markets, it's almost all active because it's so non-transparent and illiquid. Fixed income index, we did shift away from the Barclays Ag within the past year, went to the Barclays Intermediate, which reduces duration risk and lessens your risk of harm from rising rates, but you don't give up that much in yield. The real reason anybody has fixed income, though, is to have a source of cash available to rebalance if equities really tank. And you're going to pay a carrying cost for that luxury, but it's important because it's the lifeboat if the mothership starts to take on water.
Okay, let's shift gears a little bit and let's talk about discount rate. Let's begin. I'm going to ask you to answer this question with one-word answers, which is an 8% return, assumed rate of return, reasonable for the next 5 years? Let me start with Girard. Yes or no? 8%?
Doubtful.
No, I said yes or no. Come on. All right, that's acceptable. It is one word. All right. Carmen?
No.
Okay.
No.
No? All right, so let's have a more fuller discussion. What would you think is more of a reasonable discount rate for public plans? And following up on that, as we discussed, this conference is really intended for, public plan trustees. And, one of the things that I know that is a constant conversation in the public domain is, how do we talk intelligently about discount rate, not just amongst ourselves, but with the public, with the media. So your insights on that would be very appreciated. So, Ash, so what's reasonable, and then how do we talk about it intelligently?
I'm going to pull a shift on you here. Think about this. Investment return assumptions are set by legislative bodies of one kind or another, usually. Ours is set by the Florida legislature, some are set by county commissions, city commissions, etc. That means they're essentially political creatures, but they're expressions of expectations about capital markets' treatment of risk and return. Now, the last time I looked, global capital markets don't consult legislative bodies about how capital is compensated for taking risk, do they? So how did we get trapped into this? And I would argue it's been as much a function of trying to manage appropriations risk as it has been trying to anticipate anything about investment returns. Why do I say that? Because in public plan land, the investment return assumption doubles as the discounting factor when you calculate the net present value of future liabilities. So there's an automatic tension there. The higher that discounting factor is, the lower the net present value of the liabilities is. So I've seen this show a number of times. I remember back in the 90s, we had a string of years when I was at the board the first time where we had returns in the high teens. And every year the legislature does an estimating conference where they talk about the actuarial assumptions that will be used for that year's retirement system valuation. And they called me up and said, you've had these years of 16, 17, 18, 19% returns. You've got a return assumption of, I think it was 8 or 8.5 back in those days. Why don't we just move that to 10 or 12? I mean, it seems like it's well within the returns you've been getting. And golly Moses, if we discount the present liabilities using a 10% number, they're way lower, which means the cost of the contribution goes down a lot, and then we can appropriate money to lots of other good things. Doesn't that sound like a great idea? And I said no, because the returns we're getting now are anomalies. There will be mean reversion in returns, and 8-ish back in those days was pretty centrist. I'd say I wouldn't go anything above 8, and if anything, I'd pick a slower rabbit and go lower. Currently, we're at 7.75. We've been saying publicly for several years that reducing that return assumption a bit would not be something we would rule out or argue against, but it hasn't happened. And the reason is, I think, nobody wants to have the liabilities explode. So what's the better way to deal with this is the real question we're trying to answer. I'd say focus all of your policy decision-making on investments and risk-taking on something simple. What is your real long-term return objective? And when I say real, I mean real as in net of inflation. We have figured out, and our actuaries have worked with us and advised us, that if we can hit a long-term return objective of 5% real return, that is 5% more than inflation, we'll be actuarially fine. That takes all of the smoke and mirrors and political diatribe out of it. Just focus on something that is knowable, quantifiable, and is out there, and it doesn't move around every day. And that makes life simple and takes away a lot of the game playing.
Carmen? Obviously, here in Chicago, pension is a big issue in the news. A part of it is about discount and the funding status. So what's the Chicago teachers doing?
Well, I think in terms of the discount rate, there's a few things going on. One of them, and we're focusing at CTPF on this very closely, is the GASB 67, where we will have to, us and the employer will have to actually show what the liabilities are in our financials. And one of the areas of focus is the money-weighted rate of return, which actually does affect the discount rate, where we are supposed to use a municipal rate, I think, for the unfunded liabilities versus our current 775 for the funded liabilities. So that's going to affect how it looks on the outside. But I agree with Ash in terms of if we're looking longer term, we have to look at a discount rate that is stable and does not move around. Your question was, what's the expected return over the 5 years? I think we have to focus on the longer term. In going back, using one of our managers, Dimensional Fund Advisors, which has history going back to 1926, if you look at the rolling 30-year returns, going back to 1926, like I mentioned, the return is about 8.9%. So the expected rate of return of 8% is not unreasonable.
Carmen, you haven't by any chance read the question that came in from the audience, did you? Because that was exactly what was asked. What's the answer in terms of discount rate over 30 years versus the 5-year frame I gave? So, very good. Girard?
First, to go back to your original question, Kim, I don't think it was fair to ask us necessarily what's the right discount rate using a 5-year projection. I think these plans are built to be long-term, but I think everybody in the room should understand that if you've got numbers up at the 8% level, that your probability of achieving your actuarial discount rate over the next 5 years is probably less than 50%. And that's the better way to intelligently think about the problem. I, too, have done the historical research. I did a lot of work about 30-year rolling returns and what happened if you go back to the Depression era, which is the closest thing that we have in history in the United States to what we've been through in the Great Recession period. And what I can report to you is that if you had invested in the stock market or in a balanced pension fund-like portfolio anywhere in the Great Depression, including 1937, when the market had come back and then fell 50%, if you had bought at the very pinnacle of that mid-depression period, the worst possible time to invest after the great crash, of course, you still would have had long-term returns north of 8% actuarially, equity returns of 11 and 12%. So it all worked out in the long run, but it was very messy in the 5-year period. The other condition I want to impose is that you must, in order for that to work, win World War II. Okay, so, history can only teach us so much here. But what I do want to share is that when we work from a world in which the 10-year Treasury bond has such a low level, it is mathematically very difficult to sustain an 8% actuarial assumption, no matter how you try to diversify around it, in the shorter period. In the longer period, what all of the people who've done mod math will show us is that interest on those bonds will eventually work you back up. And I have absolutely no reason to believe that we can't see the majority of plans. It won't be Orange County because we have a more conservative design. And our actuarial rate is 7.25%, and I think our board wisely stepped down from 7.75% over a 2-year period to get there. It wasn't on my advice. They made that decision all on their own with their actuaries, and I stood clear of it, but that's probably the more sustainable level for a plan our size. I don't get Ash's fees. Okay, I've got a 25 basis point drag on my performance relative to what he can achieve just because I'm a smaller plan, maybe 50. And so you also need to have that in mind, that if you're a plan my size at 11 billion or lower, and you're trying to maintain actuarial return assumptions at equivalent to the state pension plans, I think you're dreaming.
So let's actually explore that a little bit more in terms of cost of management fees, especially for alternatives. Girard, I know you guys are doing something very innovative over there, so let me begin with you.
Two things. If you don't have a fee policy, you ought to have one. We've put ours online at osers.org. I encourage you to go out and look at it. Every trustee should be thinking about what is the statement that you want to make to the marketplace and how should you be thinking about fees relative to returns. We had a lot of internal debate. Our trustees really helped coalesce some guidance on that. Second, what I want to share with you is that we have done something unique in American history that is coming to my board this Wednesday for final approval. I got together a year and a half ago with my colleagues to explore the idea. First of all, raise your hand if you are a trustee or a fiduciary in a plan here that has assets of less than $40 billion. Okay? That's most of us, right? Okay, we don't live in Ash's world. I can't negotiate the fees. I have a trustee who was the former CIO of the CalSTRS pension plan, who thought that I could magically, replicate what he did in negotiating fees where people come in and kiss your ring, right? Doesn't happen. We went from a hedge fund of funds to a direct investment sleeve where I'm putting $50 million out to individual hedge fund managers. And I would walk into the meetings with these managers and they'd say, we love your patient long-term public sector capital. You guys are the best clients. I don't want any of that hot money anymore. And by the way, the fees are 2 and 20. Are they negotiable? No. I have no clout. So how do I get clout? We got a bunch of California pension CIOs together and put together the nation's first collaborative procurement in the field of private equity fund of funds management, probably the most expensive place in the market for public funds to invest. That RFP was successful. We had 14 intense bidders. We went through screening. I had a panel of my colleagues work. We unanimously selected one firm. It happened to be Pantheon Ventures, which came up with an incredible offer. Carmen, I think, is a client of theirs as well. She's going to benefit. We are getting fee reductions based upon the aggregate of public fund investments through that manager. So the more that everybody in this room puts into the same manager, the lower the fees for everybody, as well as the lower fees depending upon how much I put in individually. So it's a two-tiered system. So what's wrong with that picture? For 20 years, all of us in this community have been told to stay clear of that because it might violate federal antitrust law, which I couldn't understand because I was the CEO of a nationwide intergovernmental trust with 3,000 governmental entities called ICMA Retirement Corporation, that some of you may know in the 457 world, and never once in the 40-year history of that organization did we ever encounter antitrust. But what I can tell you is that tomorrow, my board will receive in public a formal legal opinion written by an international law firm that declares for once and for all that the process that we went through to collaboratively procure investment services is not a violation of federal or California state antitrust law. And we're saving 50% in fees, by the way.
Go Girard.
Yeah. Ash, so you...
Hey.
So you obviously are a big statewide plan. So are you taking any affirmative actions in terms of management fees?
Yes, first I got a ring. No, we've done a number of things. First of all, the median, let me give you an idea of what the economics look like. There's an outfit in Toronto called CEM that manages it's called cost effectiveness measurement. They measure the aggregate costs of pension plans all over North America. The median total all-in manager costs, rent, salaries, advisory fees, audit fees, all that stuff, the median is 60 basis points. Florida State Board sits at about 30.9 basis points, 32, something like that. We are the lowest cost major pension fund provider in North America. But to Girard's point, it's because we've got scale economies. It's because we can do our own passive management. It's because the fees that we pay on hedge funds are about half what the rack rates are that you commonly see. And having come out of that world, I can tell you, if the right capital comes in and the right scale, you will stand on your head and, pat your forehead and rub your tummy simultaneously while doing the bicycle motion with your feet to get the capital. You will do it. So you can get those deals. The other thing I would say is low costs are great, but let's not let fees become an end in and of themselves. A lot of my colleagues, I've been on various panels with, rant and rave about fees. And I always say, well, at the end of the day, if you're doing all your selection work net of fees, even if somebody has ridiculously unacceptable fees, say 3 and 30, 3% management fee and a 30% carried interest, but net of that crazy fee schedule, their performance still blows away all the competition. And on a risk-adjusted basis, you like them, I'd say hire them. Because at the end of the day, you don't pay your liabilities with fees, you pay them with returns. So never let the fees stop you from making the right investment, but always be aware that any fees you pay are to your detriment and the other guy's benefit.
Carmen, your thoughts?
I guess I don't feel that bad. Our fees are all in at 42 basis points. So I have some other statistics from our consultant, Cal and Associates. The average fees in basis points for public funds are 50 basis points, and these are all inclusive. Corporate funds are 58, and endowments and foundations are 69. So from that, you will see the big difference in terms of the portfolio overall, how alternative investments affects your total fees. Generally, endowments and foundations have much higher allocations to alternative investments. And we don't do that, although we would like to, because that is the most inefficient part of the market. However, at CTPF, because of our funding status and the major risk that we have is really the contributions from the employer. As we're building our portfolio, we also have to keep in mind the illiquidity that we can take in our portfolio. You know, a lot of these investments, private equity, private real estate, and infrastructure, those are illiquid asset classes, and we have to be very careful in terms of how much of our portfolio we can put in those.
So let me ask this next question, and I'll direct it initially to you, Carmen, because I know the Chicago Teachers has a policy on this, which is, you know, obviously at our conference, this is again primarily an educational forum for elected and appointed trustees of public sector pension plans. And as is the nature of the enterprise, trustees get exposed to new concepts, products, and managers. So from your perspective, you know, what do you think is an appropriate and good way for trustees to come back to investment staff in terms of the new education that they receive? Because I think if it's done properly and appropriately, it can be beneficial. Yet it could be overwhelming if it's done inappropriately.
Well, at Chicago Teachers, we really have a communication line with our trustees that is very open. Of course, I'm sure some of our trustees are here in the audience, and I'm sure they will get educated by many of the asset managers that are here. So those are things that we in the investment department take, you know, along with the rest of the research that we get. I think the trustees bring a point of view that has a lot of common sense. I think in this industry, you get a lot of money managers that can really impress you by their intelligence and their knowledge. But at the end of the day, all we're trying to do is meet our expected rate of return. There's a lot of marketing that is done, like the smart beta strategies nowadays. And because for those names, the fancy names that the marketers come up with, they can charge you a lot of fees. But so that's what our job in the investment department is, to really analyze what the asset management firms are really selling. And lastly, I'd like to also mention that at Chicago Teachers, what we have is something called First Fridays. This is basically a monthly meeting that we have where trustees, the consultant, and the investment management department are there to listen to prospective money managers. I think it's a forum that at least I haven't seen at other pension funds. So it's not only does it show that we do have an open door policy where people can come to present to us, but also found that forum to be very educational because it really allows us to really know what's going on in the marketplace every day.
Girard?
So what I'll tell you, trustees, is that there's a formal sales training program. I'm not going to mention the name of the firm, but they train all of the marketers the art of the complex sale. And in the art of the complex sale, Carmen and I, Ash, are what are called gatekeepers, okay? The salesperson's first objective at a conference like this is to nail access to the gatekeeper through the trustee. They want to get a vote from the trustee, but they also want to get access to the gatekeeper. There's a whole dance that goes along with all of that. So you just need to understand that you're part of that process, okay? Now, I want every trustee to remember the first rule of investment returns, which is that 85 to 90% of the returns of your plan are the result not of your interactions with marketing people and making suggestions about what fund manager might do better in the small cap emerging market value space. It comes from what? Asset allocation. And I want to ask, how many of you spend 85% of your time on policy matters like asset allocation? And what proportion of total returns in your plan do you actually believe will come from the result of trustees attempting to micromanage the manager selection process to choose manager M over manager V in a 3% space in your portfolio? So to manage that process, when I walked into OSERS, I was flooded with the usual 10 requests every day that come in from cold calling emails saying, can I get an appointment with you, Mr. Miller? And we realized quickly, I have a staff of 4 in an $11 billion plan. It's like, how on earth are we going to have this open door? And I admire everything that Carmen's doing for emerging managers. I think it's great. It doesn't work for us, but in your case, I fully understand it. But in our case, we would spend literally 1/2 of the staff's entire time. I'd have to add 2 more people just to accommodate the endless requests for marketing meetings by people who are trying to fulfill their sales objective to report to their sales manager that I had a meeting with Orange County this week. Because that's how they're scored, especially if they're not producing actual results. So I produced a letter, which is online, which informs everybody, what are we doing? Where are we going with our asset allocation? And what should you as a salesperson expect to actually happen? And where do you start? Who's the consultant that you'd want to have contact? And by the way, here's how we approach it with the trustees. And if you have the discussion with the trustee and the trustee finds merit, we have a channel that's formally laid out in guidance to marketers that provides people with some guidance. What kind of track record are we going to want to have? What's a minimum experience level? What's the minimum account size if you're a fund manager? So that there's some ground rules laid out to avoid the immense waste of human time and capital that's being devoted to interactions that have nothing to do with producing better returns.
I don't think you have a strong opinion on that, Girard.
Now, having said that, I love my friends in marketing, okay? it is not my issue. I just want to make sure you understand that we are not, going to change the rules for how we run the portfolio, which is top down, not bottom up. And when there is value, I want to see you there in the finals. And when we run a competition, we love the excellent work that has been done by the professionals. And I salute you all because you're out there. I've knocked on the doors in my prior life. I know how hard that world is. I know what it's like to get doors slammed in my face. I know what it's like to make phone calls and get stuck in voicemail that I never hear anybody back. So I have compassion for you in those roles. But we all just need to understand sort of what are the rules of engagement and how is each plan going to approach that.
Let me shift gears once again, and this one I'm going to start off with you, Ash, because I know you have a very strong opinion on this. So we're going to talk about plan design. Since the mid-2000s, essentially after the Great Recession, virtually every state has undergone some sort of a pension change. And obviously Florida is not different from that statistic. But having said that, virtually every state that has had pension change has still essentially at its core maintained its defined benefit plan design. So the question is, why do you think that is? And what are your thoughts about, sort of the new types of plans, the cash balance and hybrids, as it were? Ash.
I think what's missing in a lot of the discussion we've seen to date is a context. First of all, the pension world is an arcane world. The actuarial foundings of pensions are complicated, they're counterintuitive, they're dry as dust, and unless someone has some basic level of intellectual talent, they're completely bulletproof in terms of understanding. So that creates a bit of a vacuum of knowledge. And into a vacuum of knowledge can rush any interest that has an agenda independent of what the facts would support. And I think that's exactly what we have witnessed in recent years in public pension land. It was touched on yesterday. We've had a bit of an assault from several different groups whose interest is more anti-public employee, in my personal opinion, than it is anything else. And the pensions were an extension of it. You had the public and media receptivity to those arguments attenuated by the miserable experience in the financial markets of 2008, when many people saw private savings decimated by market downturns, at least in the short term. They've recovered subsequently. But in the short term, people suffered real pain. At the same time, corporate America had largely exited DB pension land and gone to DC. So now you had the dynamic where one of the few people still standing with a defined benefit pension was probably a public employee, meaning that the taxpayer, the voter, the media reader was the one paying that pension plan. That creates a lot of resentment if you've just been wiped out and somebody whose taxes you're paying for has what you perceive to be a richer deal than you do. And that has led to a lot of what we've seen in the past couple of years. I think you go back to first principles and ask the question, before you even engage this topic, why do you have a pension plan? And the answer is income replacement. And the reason is, if you don't have income replacement, all of us are going to hit a point where we can't work like we used to and can't produce income. And if we don't have adequate savings through personal savings, Social Security, and some sort of employment-related savings plan to have sufficient income replacement, we're going to wind up wards of the government one way or another. So oddly enough, the same kick-the-can argument down the road that's been used to motivate doing away with DB plans, I would argue if you don't replace the DB plan with something that has adequate income replacement, is simply kicking the can to a different road. Because now you've skipped out on the income replacement mission, and if you can't fulfill it through the pension plan, then we're all going to be living together with shopping carts under overpasses 30 years from now because we don't have enough money to have a house. So that's the problem you've got. And I think what we're seeing, I'm very pleased to say, if Florida is representative of where we're headed, I've seen a very, very pleasant evolution in understanding over the past 6 years. I was thinking about it in the wee hours of this morning. Every single legislative session going back to 2009, this has been subject one in the Florida legislature. They're wrapping up their session in the next few days. And what they have come up with this year is to change the dialogue and basically start looking at all the facts that we've just discussed and say, number one, DB is the most cost-effective way to accomplish income replacement, period. And if you want to then look at issues like portability, which is not very good for DB, or risk sharing, which is not very good for DB, and contrast that with DC, which is sort of the opposite. It has high portability, but the risk is all on the employee versus all on the employer. There are obviously some deficiencies, and I think if we can work around the edges of plan structure to come up with hybrid structures where, for example, an employee's contribution could go into a DC plan, which gives them portability, gives them control, gives them ownership, and assures they get a benefit, even if they're not around long enough to make a longer-term vesting requirement, then you've got something viable. The employer's contribution could go into a DB, get the efficient compounding, very powerful income replacement over the long term. It could work. So I think I'm starting to see light at the end of the tunnel, where the right facts are coming into the public debate. The right decisions are being made. I do not think the Florida legislature is going to, I'm certain this year they're not going to close our DB to new membership. And if anything, I think what they're going to do is slightly lengthen the vesting requirement, slightly narrow some of the classes who have eligibility to it, primarily elected officials and senior managers, and they'll change the default. We run DB and DC, and currently, if the employee does not make a choice, they default into the DB. Just flip the default. You're not taking away their choice, you're just saying you got to make one. Those are the kinds of things that incrementally I think make sense. We already did pension reform back in 11 where we made the system contributory, lengthened vesting, eliminated the COLA on retiree benefits after July 1 of that year. That's going to be reviewed in 2016, et cetera. So I think some of the right things can be done, and the debate is now beginning to show the benefit of knowledge that has taken a number of years to filter in after the vacuum was first filled by people with a very real agenda and a very strong strategy for getting their message out there.
Anything different from you, Carmen or Girard? Oh, okay.
No, I'd echo. I did a lot of work on pension reform in prior life. I came to this job to be on the right side to try to help work all these things out. I've been surprised it's taken as long as it has taken, but I think I misjudged the slowness of the political process and how long it takes to affect change in government and the various interests. But I think we're heading in the right direction. And the lesson I got, I ran a defined contribution company for 10 years in a prior life, was here, Hank can remember, in back of the great DBDC debates at the 1990s. And of course, if you put all your money into a defined contribution plan in 1999, you know what happened at that point, and I saw it. I was in Colorado with clients of the company I was working for who were police officers and firefighters in 2003 who, at the age of 63, were still working as firefighters because their 401A was a 101A. And that taught me a huge lesson in life, that income replacement, just what Ash has talked about, and security is in the best public interest for especially the people on the safety side. We've got to have a floor. We can talk about hybrids and everything else, but the core benefit has validity, and it's our job to try to engineer the system so that that is sustainable over the long run. And I applaud all of you for your efforts to help make that happen, because it has not been fun. I've been in a world where we've got the muckraking journalist, from the Orange County Register, whose only objective in life, as an institution as well as an individual, is to find every flaw that they can find in the pension fund. And so I've been there and tasted that world. And we're in a goldfish bowl where people have to exercise greater scrutiny simply to be able to defend the institution, and that's the job we've all got. It's a challenge.
So I think we're getting to the end. Let me close by asking this question, and it's sort of, I guess, in some way closing the loop. So we began this morning with a conversation about infrastructure investing, and as the executive director of NCPERS, I know there's been a lot of chatter and interest in this area, but not a lot of execution. What do you guys see as the future of infrastructure investing for public plans? Ash, you want to begin?
Yeah, I think it's a natural area of intersection of interests. Here we are with large pools of capital that's ultimately derived from the existence of government and public employees. These same public employees in many cases work for entities that may be providers of infrastructure or major users of infrastructure, and we're all looking for returns. And our country has done a very poor job compared to our competitors around the world in meeting our infrastructure needs. So if we could figure out a way, and the program that we heard outlined very capably earlier this morning is a great example of some groundbreaking intellectual effort in that regard, to marry our need to produce returns on capital with our nation's need for capital for infrastructure, that can be helpful. Now, what's interesting is, as a private investor in infrastructure, what I find when I talk to our infrastructure partners in answer to the question of how come all the infrastructure investments are outside the United States, The answer is the amount of infrastructure that's available for investing in the U.S. currently through a standard commercial infrastructure investment format is priced absolutely to the moon, to levels that you can't get a decent return out of it. So with the sort of program we heard outlined earlier that Jill talked about, you're talking about identifying a new set of infrastructure opportunities that aren't on the radar now, that are not anticipated to produce the sort of high returns that would merit a private equity fee structure. But guess what? In our business, what did we all just get finished talking about? Return assumptions and needs and all of that. Show me a 9% return with reasonable low risk and dependable cash flows. I'm all over it. So this is a natural for us. If we can figure out how to do this, it should be good for all of us as pension funds, should be good for our country, and good for our competitive position in the world, and good for employment too.
Carmen?
I agree with Ash. We are looking at infrastructure, and like he said, I think it is a natural reaction to the recent financial crisis. It is uncorrelated with other asset classes, and that's what we're looking at for our portfolio. And if I could just tie this in with your previous question, this infrastructure is one of the asset classes that defined benefit plans can invest in. In a defined contribution plan, it is very hard for an individual to invest in these asset classes. So I guess I want to add to the points that were made before is that defined benefit plans do work, and they are economical, and they are guaranteed. You know, I see the main difference between DB and DC as a risk transfer to, I see the DC plans as a risk transfer to the employees. So since we have a long-term investment viewpoint in the defined benefit area, we can make these type of investments which should help us in our expected returns.
Girard, I began with you, so I think it's fitting I close with you. Your thoughts?
Well, I don't want to be the contrarian on infrastructure because the general thesis has validity. But what's missing is there's a 3,000-pound elephant that belongs on this table here that hasn't been talked about in this part. It was mentioned briefly by the speaker this morning. Why don't we have more American pension fund investments in infrastructure in the United States? Number one reason, name me the one country in the world that has a tax-exempt municipal bond market. You happen to live in it. Traditional infrastructure projects in every other country in the world are financed on a taxable basis, and that becomes the capital market benchmark for returns. And so Ash glanced at it when he said, we can't find a lot of projects that meet rate of return expectations. It's because the vast majority of this nation's infrastructure gets financed quite capably at federally subsidized tax rates called municipal bond interest rates that are favorable versus what would happen with corporate enterprise. And I don't want to compete with my money trying to get 7.25% return with a tax-exempt bond market that at worst has a financing hurdle of maybe 5%. So don't take me to that sewer, please. Okay? What I do want, and what I will commend our speaker this morning, is that if there are pockets of investment in American infrastructure that are not capably handled within the very efficient municipal bond market, I'm all for it. And so I applaud the national initiative to try to find those kinds of projects. And I have every reason to believe that they are out there and that there will be reasonable rates of return. But if you try to go do public pension fund investing in a project that could ordinarily be financed with tax-exempt municipal bonds, you have to ask yourself, why aren't they going there for their capital? And so just be sure that you know what you're getting yourself into. That's your fiduciary responsibility.
I lied. Ash, you get the last word.
There's one footnote to that. That's exactly right. The U.S. is unique in its municipal finance mechanism for infrastructure needs. The one footnote to the outline Girard just gave us, I think, is that there has been a very powerful trend. It's the same conservative movement that we've all seen on the pension fund side is there's a very powerful anti-debt and debt reduction movement in this country's leadership right now. In Florida, we have dramatically reduced our bonded debt. We have significantly constrained new public bonding programs, whether they're for infrastructure or anything else. And we are already one of the most debt-free states in the country, and where we are now, it's a fortress balance sheet. It's just really a strong balance sheet for our government. But that's the constraint. So to the extent the traditional needs of infrastructure are being constrained, those needs being met are being constrained by an unwillingness of governments to use the municipal finance infrastructure, then that could create an opportunity here.
Absolutely. And the more of that comes along, especially with what are called private goods, where there is a pricing mechanism and revenue availability and all the rest, that's going to look just as it does in Europe and any other country where you don't have that financing. But just, you know, a word of caution, don't forget that big elephant I talked about.
Ladies and gentlemen, as you can imagine, the incredible business and scheduling constraint that our panelists have today. So please join me in thanking them for sharing their valuable time with us.